Let's take a closer look at the possible effects of the tax bill on the economy. Joining us now, economist Peter Morici, who is also a professor at the University of Maryland, and Sean O'Hara, president at Pacer ETFs. All right, Peter, I want to start with you. Let's talk about broad economic impacts. You know, the president says this is the biggest tax reform in history. That's really not true. The Reagan package was bigger, but this is not small. What do you see happening to the economy going forward?
Well, I think it's going to give the economy an immediate boost because ordinary folks are going to have more money in their paychecks from changes in the withholding schedule right away. Longer term, this should provide a lift to investment in the United States, both in, say, factories and new offices and things of that nature, and R&D. You know, as a consequence, the economy should grow more rapidly, and we should start to see productivity pick up again. We've had lots of new technology in America, but it hasn't been applied because businesses facing such high taxes simply hadn't want to invest here. That should now change.
Sean, you know, big benefits, of course, for corporate America, a 14 percentage point corporate rate tax cut, and lots of other benefits that people don't really talk that much about, including immediate expensing, write-offs of stuff they purchase for their business. So that's a big benefit. And according to one expert I've seen on this, earnings are expected to rise 7.9% on the effects of the tax bill alone. We've already seen sort of a 3% gain in the wake of the House passing that legislation. What do you see for stocks going forward this year? Is there room to run on the basis of this tax reform?
Well, I think the environment continues to remain very healthy for equities. I mean, they're obviously at the higher end of the valuation. I think a couple of things will happen to valuations. I think, as you said, the tax bill certainly helps corporations, companies, and stocks because if they pay less in tax, that should go straight to the bottom line and increase their earnings. The other thing is that there's a lot of folks that look at like a smoothing or a 10-year PE ratio that's called the Shiller PE. 2008 is going to come off of that this year, and so that'll have an effect in terms of lowering overall market PEs. And I think people are not paying attention to that. But as Peter said, you know, the economy for 8 years grew, GDP grew at under 2%, and everybody was convinced that that was the new normal. And I think in the first year of the Trump presidency, you've seen something really dramatic happen. Lower regulation, an overall increase in everybody's enthusiasm for the business environment. And then this is a major, major deal for the Trump administration to get this done the first year. And that's all good for equities. All good for equities.
But let's drill down a little bit and talk about what sectors might benefit. Peter, housing might be one that doesn't do so well.
Well, middle-class folks don't have to worry about this bill when it comes to housing because, you know, the first $750,000 in your mortgage, the interest on that is still tax deductible. It's going to have an effect on everybody with regard to this business of deducting state and local property taxes. Right. On the other hand, they're going to have a bigger standard deduction, which means they're not going to be so concerned with where they put their money as they'll have more money to spend. They'll have more choices. So I think that's a good thing. Finally, the millennials are coming into the housing market. We've been seeing that in traffic and so forth. So I think we're going to have a big surprise on housing, that housing is again going to be a leading sector of the economy in 2018 and 19.
Wow.
Yes, I do think so.
That's a surprise. Sean, to you, quickly, tell us your top sectors for 2018. Where is the money going to flow?
Financials, primarily big U.S. banks, healthcare, pharma, and hospitals, I would say would be big beneficiaries. Consumer discretionary stocks and energy are the big winners. If you look at companies that would be called cash cows, we like to call companies cash cows with high free cash flow yield, but there's companies with huge balances offshore. Cisco has 37% of its market cap in cash outside the U.S. Those companies will repatriate a big chunk of that money. There are those that think that they'll pay out big dividends as a result of that. They'll either do one of three things. They'll buy back company stock, pay back dividends, or invest that money here in the U.S., which is what we want.
So, Sean, that's interesting. But, Peter, we're not guaranteed that the money is going to be spent the way we want to see it spent, right? Hiring people, expanding companies. It might be given back to shareholders. Tell me what your view is on this. Where's the money going to go?
Well, I think it's going to be a bit of each. Certainly, there's going to be a stronger incentive to invest in the United States, and I think we will see an increase in investment of somewhere between 7.5% to 15%, and that'll be continuous year after year after year, which will boost growth about 2 to 3/10 of a percentage point. Sounds small, but over time, it really adds up. That could be the difference between growing at near 3% and growing at more like 2.5. But if you give it back to shareholders, I mean, the Democrats, Chuck Schumer, have been talking about it like it's Daddy Warbucks. I mean, he should be ashamed of himself. More people in America own stock, including people that live in New York, and they will have more money to spend. What's wrong with giving Grandma more dividends in her IRA and Keogh, which she's using to get along? I don't get it.
All right, I love it. Okay, guys, thanks so much for helping us out this morning. Sean and Peter, thank you.